Hey, it's Tim. It's 8:45, and it's a nice, healthy pullback in emerging markets off of Chinese data that may be a little too hot for some on the inflation side. Central bank rate cuts in Turkey, which catch the market off guard and have people worried actually about policy that looks like it's going to figure other methods to tighten conditions, but definitely and strangely enough a tightening condition as Turkey cuts rates. And Brazil, which also hiked rates last night, has sent another message to the market that there's more to come, probably at least another 100 basis points of tightening, other measures which are part of the concern in that market. So the A-shares market in China off almost another 3%. We talked about this 2,700 level where it was worth taking a shot at 26.77 last night. I think maybe you do start to look at that. The reality is that China does have food price inflation, and they have a speculative, don't need to call it a bubble in their property sector, but the reality is that this is an economy that is thriving on increased global and developing country demand. You can see it in the exports, you can see it in the GDP numbers, and that's ultimately not a recipe for a crash landing in China. I don't care how aggressively they go, because they're not going to go that hard. The reality is that you've got a marketplace that's run around the world to an extraordinary level over the last 6 weeks. Freeport announced numbers this morning, beat, but guided a little lower than forecast on production. Stock down 3%. A number of earnings over the last couple of days, but last night a couple of the high-flying beta names in the tech sector in the U.S. got crushed. You have Morgan Stanley with actually decent numbers this morning, giving a little back to the bulls. But the reality is that markets look like they want to pull back a little bit. It looks like maybe the worst of the morning is over. But the wounded charts in coal land, in oil land, in some of your kind of industrial resource players is pretty significant. And I think you wait for your spots here. It's not going to be as clean as you want, meaning I don't think you get a nice healthy pullback to using the S&P as your guide, 1237, to a nice healthy 50 moving day average. If you're looking at the EEM, we'd probably be talking about somewhere around $46, 46.50, which is another 3-4% from here. But I would use that as your target, because I think EM looks a little extended as well, and you can see this topping pattern that peaked around 48 in the EEM. So I'd say stay loose and don't expect a free fall, because the data's too good, the earnings are too good, and everybody wants to own this thing at lower levels. With that scenario, it's not going to go a whole lot lower, but needs to go a little lower here. Thanks.